I'm going to talk about different types of investment funds, ETFs, mutual funds, index funds. You might have heard of these things, but not understand like what they are exactly. Now, an investment fund is basically a group of stocks or other what we call securities, so like bonds and other things that get bought and sold together in one package. So instead of having to buy all 500 stocks of the S&P 500, you just buy the fund that contains all those stocks. So that's you pool your money together. And a mutual fund would pool the money from various investors together to collectively buy securities, and that helps with diversification. Obviously, like I mentioned, it helps with strength in numbers because you have access to investments that you might not necessarily have otherwise because you don't have enough money as an individual. For example, Berkshire Hathaway, which is Warren Buffett's company, costs about $300 a share, $300,000 a share, and most people don't have that much money to buy a whole share. So another thing to consider about investment funds is that there's an expense ratio. So they charge you money every year. Basically, they pay the people that are buying the securities for that. So that's basically what it is. Run the fund. Now, a mutual fund is, like I mentioned, it's where you pool your money together with other investors into a portfolio, and it's overseen by a portfolio manager, which costs money. Initially, to invest in a mutual fund, you have to have about $3,000. I've seen them go between 500. I've seen some as high as $1 million. I'm sure there's others that are higher than that, where you have a minimum investment of millions of dollars. But most mutual funds you can get for about 3,000, and then subsequently you can invest any amount of money. So I like to liken it to a like a bowl of soup. So you can put as much or as little liquid as you want in there, and it increases the size of the bowl of soup, right? So consider each of those chunks of vegetables are individual shares of companies. So you have thousands or millions of shares in one bowl of soup that makes up the mutual fund. Most mutual funds tend to be active. So active is where the mutual fund manager, the portfolio manager, tries to pick stocks to beat the market, to get a greater return for the investors, right? And an example of a mutual fund is VT Sachs. Now, this isn't an active fund; it's a passive one. It just tracks it's the whole U.S. market, all the stocks in the United States. It's called the Vanguard Total Stock Market Index Fund. Um, and compare that to an exchange traded fund, which is basically a fund that gets traded on an exchange. So like a stock exchange, so it gets traded much like a stock. And much like a stock, it gets sold in shares. You can only buy it in whole shares, whereas mutual funds allow any dollar amount, like the bowl of soup. You can put as many drops as you want, or as many chunks of vegetables as you want. You have to buy an ETF is like a cake. You have to buy whole slices, but you still get all with the soup you get a big spoon and scoop it all out. With the cake, you cut it into slices, and you still get the layers, and each layer is like a version or a part of that stock, right? And an example of an ETF is VTI. So this is also the Vanguard Total Stock Market, but it's not a fund, it's an ETF. Well, it is a fund, but it's not a mutual fund, it's an ETF. So it gets traded in slices on an exchange, right? Now, an index is basically a list of stocks. So it measures, it's like if you want to say, like the total stock market is an index. If people want to know how that benchmark is doing, how there's like a healthcare index, there's like a tech stock index, the NASDAQ. There's the S&P 500, which is the 500 biggest companies in the U.S. And people tend to look at like the S&P 500 as like the overall stock market. Also the Dow Jones. S&P 500 contains like a little over 500 stocks, and the Dow Jones contains 30 stocks. But they're very highly correlated because they're the largest companies in America. These are, for example, these are the 30 stocks in the Dow Jones, and you'll notice a lot of names that you recognize. Now, an index is a list of stocks that tracks some sector of the economy or some industry. And an index fund is an investment fund in investment funds that tracks that index. So basically that contains all the stocks in that index. And it can be in mutual fund version or an ETF version. Yeah, it's a portfolio constructed to match or track the components of a financial market index. It also gives you diversification because it contains a whole bunch of different stocks. And it's a passive way to invest. So you're not trying to pick stocks. You're just buying all the stocks in a certain index, and you hope that the market will outperform anything that an active manager can do, right? And the cool thing about index funds is that since it's passive, you don't have to pay anyone to like uh, research. So the expense ratio is super low, like and has low portfolio turnover, so they're not constantly buying and selling, and that costs money too to buy and sell. So that tends to active funds tend to get their returns reduced dramatically because of all the commissions, because of all the trade costs, because of the expense ratios. Active funds have cost you anywhere between like 0.6 to like 2%, sometimes more. Hedge funds can charge you like 5%, and this is a year. So, so for example, if you have $100,000 in your portfolio, you're paying 1%. That's $1,000 a year. That money could be used to grow, but it isn't. So it's been proven that active funds tend to underperform. I mean, based on the manager, but more funds tend to underperform passive funds in the long run. So for example, it's 1 to 2% for an active managed fund, but check this out. If you have VT Sachs, it's only 0.04%. So that's for every $1,000 you have in there, that's only 40 cents a year. How much is that? 100,000. That's like $40 a year on 100,000, something like that. Yeah. So it's very cost effective for most people, and most people would benefit from that. And just to show this, the active, look at this. This is how many managed funds beat their benchmarks. So people that tried to beat the market, this is how many actually did. Over a 1-year period, 40% managed to do it, 60% did not. And as time goes on, the longer you'll go on, the less likely an actively managed fund is to get better returns in the stock market. So to recap, a fund is just a group of people investing their money together, containing multiple stocks. A mutual fund is like a bowl of soup. You can scoop out the thing and you have all the stocks swimming around. An ETF, and for mutual funds, you can put any amount in there. ETFs are like a slice of cake. You get the layers with the different stocks, but you have to buy whole slices. And active funds tend to do more poorly than passive funds in general. I mean, some active fund managers are good, but it's difficult to find those. You never know if they've been doing well in the past. You don't know if they're going to continue to be able to